by June of next year, I believe we're going to see material delinquency. And so 2025 is where I think we'll see the biggest drop in home prices, followed by probably subsequent years of minimal but still persistent drops in home prices.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, the Fed's now cut its benchmark interest rate by 75 basis points, and yet mortgage rates have risen, back up near 7% for the average 30-year fixed mortgage. Now, this has not been good news for the housing market, which has been frozen transaction-wise at record levels of unaffordability for the majority of aspiring purchasers. It's been often asked on this program, how long can the housing market remain broken like this? Well, we may be finding out the answer to that. In a growing number of metros, inventory is rising, substantially in many cases, prices are coming down, and long-standing real estate barons are starting to break their cardinal rule to never sell. Is this growing trickle of motivated sellers that we're now seeing as more and more regional housing markets start to thaw likely to soon become a flood? For answers, we're fortunate to hear today from mortgage expert and housing analyst Melody Wright. Melody, thanks so much for joining us today.
Thank you for having me, Adam. It's my pleasure.
Well, it's such a pleasure always to have you on, Melody, but particularly now. I think we talked about this in your appearance in Thoughtful Money's conference a few weeks ago, but I don't think we've talked about it on this public channel yet. You live, sadly, right in some of the worst of the path of the Hurricane Helene, correct?
Correct. Yes.
Yeah, and that was very devastating for many, many communities that really never imagined they'd have to experience a hurricane. There's a tremendous amount of rebuilding that's having to go on there. First, I'm just glad you and your family are safe. And I know that you've been very involved in the efforts there to help people start to rebuild their lives from that. So anyways, thank you so much for the altruism and just the good Samaritanship that you're showing.
Thank you, Adam. I feel like it's my duty. But thank you.
The world needs more Melody Wrights. And actually, I'll just say, folks, like, well, maybe we talk about this at the very end, Melody, but folks, if you're looking for ways to help some of the victims of recent hurricanes, go check out Melody's Substack. There are ways that you can help there. All right. Well, look, I asked a big question here in the intro, Melody, so let's dig into it together here. Maybe we'll start with a general question and get specific. What is your current assessment of the U.S. housing market?
Well, Adam, it's about to get really interesting. And, we've seen so much has really happened over the summer to change things, including those upticks in delinquency. We're seeing the lowest activity, the lowest sales, excluding 2010, for a September since 1999. And that's the data series that I have. And that's a combined sales with new home sales as well, which is just absolutely remarkable because that's not adjusted for population either. And so
Wow.
it's remarkable, right? What we're going to see, just so everybody understands this next month, is we're going to see a pop in sales month over month. And the reason that is because many closings were canceled at the end of September due to Milton, a big part of that, as well as these other, communities that were impacted. So we will see a month over month pop, but it's still going to be from very, very low levels. And that's also when rates were down a little bit, as you mentioned, but to most people's minds, including the realtors out there, this shouldn't be happening, right? The Fed shouldn't have cut rates, and mortgage rates went up. But I think you and I have talked on your channel many times about the mortgage rates. They don't follow the Fed funds. They follow the 10-year Treasury. And that, to everyone's consternation, is not behaving like they want it to. And everybody has a reason, be it from the Trump trade to, the Japanese. I mean, but that is really what mortgage rates follow. And so what we're about to see is this reminds me very much of October 2022, but we're going to see that little activity we got in the summer is going to grind to a halt because people, and let's be clear, it really didn't, people are going to talk a lot about that uptick, but in reality, the biggest uptick was in refinances. When you look at the actual what closed, not in purchases, there was an increase due to the lower rates, but not anywhere where that I think people were expecting. So what we're going to do is kind of grind to a halt here, and this is out of the house. Like, this is not typical season. It is season for Florida. They start in October. But what I'm seeing right now happening, like you say, inventory is definitely increased year over year. I mean, exponentially in many places. Um, but what I'm starting to see right now is people are pulling their listings because of the higher rates. I think people got it wrong. They thought those lower rates would bring out the buyers. What it did was actually bring out the sellers, and now they're pulling back. And so I don't think that's going to last very long, though, because I think there is so much motivated selling at the moment due to just those increased property taxes and insurance. And by the way, with what just happened with the hurricanes, before Helene hit, North Carolina was considering a 42% increase in insurance, home insurance, 42% before Helene.
Before, wow.
They just had their hearing and it got postponed to October. So Unusual Wells on X Twitter came out after Helene, a 42% increase. And I was like, no, that was a delayed hearing. So what is that going to look like after Helene, right? And so the other thing that these hurricanes have done, I think you and I talked about it, but I don't think we talked about it here. Only 4% of Americans have flood insurance, according to FEMA. And most of this damage is going to be flood damage. And it's, very similar to what we saw with Katrina, right? And so the rebuild is not going to look like what I think many people are assuming. In fact, what I'm seeing here on the ground are the Mennonites, the Amish people just doing construction. I mean, they're the ones doing it. And so I think some people are thinking, oh, there's going to be this huge uptick in employment around disaster relief. On a net basis, I don't think that's going to happen, as well as a lot of these people are on the hook for a mortgage for a home they don't have anymore. So I did an analysis recently looking at all the FEMA impacted counties going back to Idalia last year. And you can clearly see in those counties where these hurricanes hit the increase in delinquency, and we saw it with Beryl and in Houston, in those areas. And so we are about to see the same thing in these counties impacted by Helene and Milton, just because people cannot afford to rebuild. And I think that's going to accelerate that motivated selling, which might turn into distressed selling by late spring, in my opinion. So the spring season is going just like last year. It told us a lot about what was going on in the housing market. That's when we got all that inventory. This year, I think, is going to tell us a lot about the direction of home prices.
Okay, you mentioned two really important adjectives there. I just want to underscore for viewers here. I think we've long heard about the motivated buyer, right? The person who is just feeling the FOMO and they just want to get in, right? This was the story of basically, post-COVID stimulus boom, right? Everybody was going to work from home, out in, away from the cities.
Right.
Everybody was, flush with excess savings, and they were watching property values go up in the places they wanted to move to. So everybody was scrambling to get in there. It really sounds like now that term motivated is increasingly going to be applied to sellers. You're nodding as I'm saying all this. Presumably, as time has gone on, as this market's been frozen, the sellers have all been trying to kind of hold together and say, look, let's not bring our prices down. Let's just nobody sell, and hopefully the Fed will
Get
ride to
through
our
it.
rescue here.
Yeah. Yeah.
Yeah. And but as time goes on, you have more organic reasons that you need to sell begin to build up. You're getting old and you want to downsize, you're getting divorced, you have to move for your job, whatever. All these reasons
Right.
stack on top of one another, and they've been kind of trying to resist having to do it. But the longer that this market stays kind of broken like this, more and more of those people have to start dropping out and selling. As you've said, when we've had some windows there in the market, it's the sellers that have showed up, not the buyers. Now, again, they may be pulling back their listings because they're trying to wait out this latest bump up in
Right.
mortgage rates. But you are saying that you don't see any real relief on the horizon for these folks, and not too long from now, like maybe as soon as the spring season, they're going to go from motivated selling to distress selling, which is I have to sell because my
Yeah.
insurance has gone up to the point where I can't afford my home anymore, or
Yes.
maybe I can't, I retired and my income's now burned through a lot of my excess savings. I just got to go.
Right.
So it seems like, a lot of people look at the housing market and say, well, it hasn't broken yet, so maybe there isn't a problem. It sounds like you see this as like a dam that increasingly is showing cracks, and at some point, unless something big changes, those cracks are eventually going to open the floodgates.
Absolutely. And I mean, it is broken. I think that's what so few people to have to go back to 1999. I mean, this is just that's insanity that these sales are lower than 2007, 2008,
Right. A quarter,
2009. Like,
quarter century. I mean, that's a
yeah,
long time.
yeah. And so I think that there's been so much narrative out there that telling us it's not broken, but it is severely broken. But I agree with you. I think that the cracks are in the narratives, and those are starting to break because I started seeing it. We've seen it in the FHA borrowers for almost 18 months, really. And so I've been seeing cracks and cracks in home prices in places like Texas and Florida, and even beginning in California,
Mm.
despite the NVIDIA mania. And so I think the narrative is cracking, and pretty soon that it will unleash a dam. To your point, Adam, it's all going to come. And the other thing that in June of 2025, that's when a lot of those rate buy downs are going to reset, very similar to the arms of the last cycle. And so if they can't refinance, everybody was banking on that. And so you've got increases in insurance, you've got property tax increases, you've got replacement, costs going up. And then you're also not able to refinance. And so many people are not in the money for a refinance at this point.
Right. Yeah, that's what I've heard is that, so many people were able to lock in,
Right.
3% mortgages, some even lower, that we'd have to have a tremendous drop in the mortgage rate before those people qualify, or have the ability to refinance at anything competitive, right?
Yeah, and we'd have to have more mortgage-backed security buying. I mean, that is the only thing that would do it. And I don't think that would even work this time around to get those rates that low. And I mean, as we've seen, the Fed doesn't have control of the long end of the curve.
Right. Okay. Kind of rapid fire questions for you. First, so I think you intimated this, but let's just get it straight on the table. You're beginning to see delinquency rates rise, correct?
Absolutely. We saw it in June. I came on to talk to you.
Right.
I talked about the push and pull of delinquency because there's so many programs out there, and there's still what we call half funds or homeowner assistance funds, still billions of dollars that are there to deploy to help people in trouble. So you'll have a push and pull, and so it kind of moderated. But then this last month, we had another double-digit basis point increase in delinquency. And so we are back on track. And this is also seasonally when you start to see delinquency because of the holidays and things like
Yep.
that. So we've got so much at our backs from a home price decline perspective as well as a delinquency. And so, yeah, the consumer is completely tapped out. And if they can't refinance, they're going to be I think the cracks have already started to show, but it's going to look very by June of next year. We're going to see that distress. It's going to be front and center, and nobody will be able to ignore it.
Okay. You mentioned rate buy downs are beginning to come up, or I guess they're expiring, but anyways, they're coming up for readjustment. So the
Right.
rate will go up, presumably. You said it's going to be like the arms that were a big factor during the previous housing bust. Um, are these rate buy downs, just to make sure I'm understanding, when you say rate buy down, is that when someone's buying a new home and the home seller, the home builder is giving them like a teaser rate, basically?
If only it were the new homes, Adam, but a lot of the lenders came out with these as well. And so I just want to be clear, I don't have good numbers. So I say it's going to act like the arms, and we can absolutely find good numbers on those, right? But we don't have a good source of information because a lot of servicers don't track the buy down. So it could be a new home or it could be an existing home where the lender and UW, United, Rocket, they did this where they basically bought that rate down. Now, here's what they were doing. They have to hold those funds in escrow and they kind of advance those funds to the trust. Well, they were earning some pretty good money on those, right? They could park it and earn money. That's changed a little bit, and not hugely material yet. But if the Fed continues to lower rates, that is going to impact them, and their margins are going to get crushed. Both the builders and the lenders who did this. And so, one thing I'm really trying to do is get my arms around how many of these are out there. But if you read Zellman's report, all the builders are doing it and they're doing it on steroids right now, and it's the only way they're really propping up sales. So this is going to be impactful. I'm just trying to size it at the moment.
Okay. I remember back in 2007 or so, there was a chart by CS First Boston that made its way around. You probably remember it, that showed the schedule of ARM resets going out in future years. And those of us that were watching this closely before everything hit the fan, that was a big data point where we would say, hey, look,
Right.
this looks like it's going to be trouble going forward, right? And of
Right.
course, it proved to be. Sounds like someone hasn't created that chart yet for these mortgage resets.
I'm trying. I am trying to do it, but it's kind of like the debt maturity wall schedule on commercial real estate. It's the
Yeah.
same. It is a wall, and yeah, it's out there. So I hope to be able to come up with one of those schedules, Adam, to wake people up to this issue because most just so I'm from a very regulated industry where you have to now after the GFC you have to send out all kinds of crazy notices at certain times when those arms are about to reset. That was a big outcome of Dodd-Frank, where all these regulations so that no borrower could be unaware of when that was going to happen. But when I went to go visit certain servicers last year as part of what I do for clients, I asked them specifically, do you have a letter yet for the buy downs from when those reset? And they just
Mhm.
looked at me with like I was had horns or whatever. And I'm just like, guys, this is the same thing. And so, my point is just that so many people are unaware, even those in the industry, of what's actually happening. And these will have a significant, they also, when I was there in October, when I started talking about increases in delinquency and are they staffing up, they were completely unaware as well. Now, those same servicers, as I do reviews of delinquency reviews, they don't have enough staff to take the loss mitigation calls. And so that's where you're calling in and saying, "Hey, I'm in distress. I
Right.
need a modification." Well, another outcome of Dodd-Frank and the national servicing rules is that if every borrower who's in default gets a single point of contact, because the big complaint was people would call in over and over again, have to start the whole story. And so all those single points of contacts right now are booked up and people can't get an appointment. And so this is all going on under the covers because and also we have early delinquency, like we're seeing the 2024 vintage, and that's the year of origination, going
Yep.
delinquent at a rate we haven't seen since the GFC. And 21 and 22 look terrible. But this is all just kind of being hidden under the prime borrowers right now, in the aggregate. You have to go to different sources to see this happening or be involved directly.
Okay. Yeah. And that's why your intelligence is so valuable here. So if folks are just reading the headlines, they're obviously getting the story that everything is still fine.
Yes.
Um, One of the last times we talked, I asked you about a comment you made relatively recently that a lot of the mortgage lenders, and particularly the newer ones that have cropped up since the GFC, like the Rocket Mortgage and whatnot, I think you said something like they're about to realize what hell is,
They
right? And
are.
that's because you went through hell
Yes.
in the 2008 crisis. They don't have, since they weren't around then, or many of them weren't around then, they don't know exactly how bad things get, and you're saying they're totally not prepared for it. But it sounds like, is it not just the new guys? It sounds like maybe some of the old guard too is still too understaffed for what you see coming.
I think the old guard is too, but they pulled back. They pulled back. They also are very sophisticated about transferring that risk. Doing certain types of non-performing loan sales off to unsuspecting pension funds and private holders. And just to mention, today's headline, Adam, is Rocket. I think lost $483 million this in Q3.
In a
When
single quarter?
yeah, when
Half a
origination was
billion
going up.
dollars in a single quarter, huh?
And but it's so predictable, Adam. So when rates go down, your servicing asset also gets written down because the idea is you're going to lose recapture. So people are going to refi, and then the asset you'll lose those people out of the pool, and so the asset gets revalued. And so the fact that Rocket was not properly hedged for this tells me everything I need to know about what's
Yeah.
coming for them. So, and it's going to be ugly, and it is all too familiar. Let me put it that way. But yeah, the banks, they pulled back as Basel III came out. This is why the non-banks exist, because mortgage assets were higher risk weighting. But they still got over their skis. I mean, and it's so funny to me. Just in the same way Ally Bank got over its skis with autos after
Yeah.
beating up the mortgage unit, saying the only reason we lost money was because of mortgage. We don't do that type of stuff. And it's like, oh, really? Okay. So the banks won't be impervious, but they'll probably be the last, where we see it.
Okay. And I got to imagine this is going to make you feel like you're taking crazy pills where you've seen how bad it can be. You've gone through it. You know the industry went through it, and yet you still see many players making the exact same mistakes they
It's
made
crazy.
not that long ago. Like this should still be burned into our conscious memory.
Yes.
All right. So, to the people that say, it sounds like Melody is really just, kind of whipping up fear here because what are we talking about? Yeah, there's California, I mean, Texas, yeah, and Florida. Well, a lot of those places got too hot, those markets got hotter than they should have during COVID when everybody was moving to the sunshine states. Um, you know, National shortage of inventory. I'm not seeing these issues. Houses are still going for bidding wars in my neighborhood. Now, obviously, real estate is super local, so there's no one size fits all prediction for the housing market here. But from what I hear from you and read from your recent work is that you do see this as a contagion that is continuing to spread, and it'll affect different areas differently. But in addition to Texas and Florida, which, by the way, are two of our most populated states,
That's right.
California, which had been looking like it was staying out of this, you're beginning to see signs that it's now infected, correct?
Exactly, exactly. And honestly, once California gets all the way on board, there's not going to be any denying it. And I track over 80 markets, including those that folks say won't be impacted. They said it about Dallas. Dallas already has year-over-year price declines. So even the people that said that wasn't going to happen are now out on YouTube saying it's going to happen.
Hmm.
And so it's this I think what people believe the BS, Adam, and what I mean by that is most of these people are overly levered. Even in these wonderful neighborhoods, they've taken out too much leverage. And so all of a sudden, everybody's still driving their car, still going to the country club. And then overnight, those people just start disappearing. Where'd they go? Where'd they go? Well, they're going bankrupt, is where they're going. And so these neighborhoods that everybody thinks are not going to be impacted pretty soon, they're going to wake up and they're going to be seeing for sale signs. And you can see it in places like Newport Beach. Inventory has risen there significantly when everyone told me that Newport Beach would never be impacted. And so, am seeing price declines there. And by the way, I think what most people miss, Adam, especially those that buy into the inventory shortage narrative, is the amount of speculation that happened. And it started back in 2012, really, when Wall Street came in and started buying up those homes. Everybody got the fix and flip bug. And then they got the short term rental bug, which was a thing. It was growing very significantly before COVID. And then COVID was just like a shot of steroids, and it just went insane. And so when you look at the coast of San Diego, all you can see are little red dots. I showed you that. I showed everybody in the conference that
Yeah.
little red dots. Those are speculative, and a lot of that was actually tied to PPP money. I've got a RE Watchman is a colleague of mine who's done deep analysis into county records, showing that people who got that PPP money went out and bought homes, and so this is all drying up. And I think people are going to be very surprised when they see the amount of inventory that's going to come on the market in the spring.
Okay. And I was going to ask that, and it sounds like the answer is yes, but how much of what you're seeing in terms of the inventory hitting the market is a motivated residential seller versus these more institutional or short-term rental speculators who got over their skis and are saying, I'm just out?
The institutionals in certain markets are becoming very aggressive, like in San Antonio and places like that, and selling. But I think right now we've got a combination of the mom and pops, especially in places like, when we were talking about Helene and Milton and Debbie and Idalia and Beryl, a lot of the areas that were hit were big short-term rental havens. Asheville, very tiny
Mhm.
town, 3,800 Airbnbs or short-term rentals. All these little towns that nobody really knows about, like Blowing Rock, Banner Elk, huge tourist towns. And then, of course, Florida, where I shared on X Twitter of somebody painted their house saying, we give up, we're leaving.
Yeah.
And so I think right now a lot of that motivated selling and inventory are second homes, third homes, and less sort of primary homes.
Which is what you'd expect, and you and I have been talking about this for years, and it's validating yet sad to begin to see this, which is,
Right.
there's so many homeowners that the home is not the roof over their head, right?
That's right.
And that's one of the dangers when you let so many um, third parties come in and compete for single family homes.
Right.
That it sucks up inventory for people who really want to buy, and that's where we get the unaffordability gap we have right now. But
Mm.
it then gives you this sort of hair trigger danger where when times get bad, a much greater percentage of sellers than normally come onto the market and just say, just get rid of it, right? And then prices can go
Yep.
down very quickly. And you're nodding as I'm saying
Absolutely.
all this.
Yeah.
The analogy that comes in my head, and I'd like to see if you agree with this, is um, everybody kind of remembers high school chemistry class, right? Where you would play with saturation with a liquid, where you would put a substance into the liquid and you continue to stir it and whatnot. And then all of a sudden you'd hit a magic saturation point where when you added more elements to it, it would precipitate out, right? You'd start seeing it build up, right? So you go from everything looking fine, and then you get this phase change where, okay, bang, all of a sudden you've got too much. And I you and I have talked a long time about this, which is, and correct me if I'm wrong here, but I don't believe you think we have an inventory problem in the US, meaning a shortage of buildings.
That's
We
right.
basically have an ownership distribution problem where too many of the inventory is owned by these third parties that aren't living in them, right? So the available uh, slice of the inventory for the aspiring home buyer is a lot smaller than what it was. And it's sort of, you get to a point where so many people begin buying that all of a sudden you get to this point where like, oh, there's just no homes left over for the regular aspirant. That's where we've
Mhm.
been. We may
Right.
now be reversing, right? Where all of a sudden there's no homes, not enough homes. Then all of a sudden, like, whoa, wait a minute, where did all these homes come from? And all of a sudden we have way too many homes. Everyone's complaining that they're dragging home prices down. Is that analogy an accurate one?
Oh, it's so fantastic, Adam, and I'm jealous of hadn't thought of
Steal
it
it.
before,
If it works, steal it.
but take Fort Lauderdale. Take Fort Lauderdale. I mean, that was such a hot market. People could not, they were falling all over themselves trying to get into Fort Lauderdale. I mean, when I was there a year ago, visiting with some locals there, it was so sad. Like these homes that were people's homes had gotten bought up and were in the midst of a cheap fix and flip, for a short-term rental homes, like next to a power station, thinking they were going to get $400 a night on Airbnb, because everybody was telling them that overnight inventory exploded there as, signs of trouble. And also that area was impacted by a big flood. And one of the ways speculators got in there was coming in, buying those homes up cheap because people were having to walk away for similar reasons as what's happening in Helene. And let me just tell you a quick fact. So Asheville, I mean, this breaks my heart. I love that city, but it was hitting in my tracking. I've been tracking for 2 years. Week after week, we were seeing inventory go higher and higher, exploding in Asheville. Okay, so what do you expect happen as soon as the storm hit? Saw a big drop in inventory, right? But not as much as I thought. Only by a few hundred. Well, as of last week, a week ago, this past Sunday, inventory has started growing there again. I think that should tell you everything you need to know
Mm,
about, this housing market. And it's not, and you look online, you look at the actual homes, it's not the ones that were impacted. So um I think that is the most telling sign and signal. And last year when I drove through Fort Myers, which was hit by Ian, now hit again by Milton, what I saw were empty lots for sale, right? And those are still there. So there's so much speculation, just as you say, we are about to be wake up, and it's going to feel overnight to a lot of people who have not been paying attention, and the markets are going to be absolutely saturated, and so sad for the young buyer. So imagine yourself in one of these Fort Lauderdale neighborhoods, and then suddenly it's just empty. I mean, people, everything's for sale. What does that do to your home values? I mean,
right.
it's a sad situation. And these new home subdivisions as well. It's already happening where institutional sellers, you bought in there, you think, great, oh, look at this wonderful playground, oh my gosh. And then all of a sudden the builder's like, well, we can't, we're turning this into rental. I mean, and I've seen some of these new communities that were turned, the originally, single family residential, turned to rental, and they look like they're 15 years old already. I mean, so these are the types of things that are about to happen to folks who are sitting there looking at their estimate and feeling pretty good about things.
All right. I do want to I do want to do a little devil's advocate in just a
Sure.
moment about, hey, what could turn this around? But before that, in the intro, I referenced something that you wrote recently where you said even the scions of real estate, right? The multi-generational real estate barons, people that have built their empires on real estate. They've done that basically following a cardinal rule, which is just never sell, never, ever, ever,
Mhm.
ever give up your real estate. And it sounds like you're now seeing some of those folks starting to break that rule. Is that true?
Yeah, absolutely. And I mean, it was, I forget what publication. Oh, it's the Wall Street Journal, I believe, that did an article on it. These are very storied real estate folks that have been in the business for a long time. And what kind of happened is, I think what people argue is that instead of investing in that asset, which so many of these second home buyers have done, they were just giving out distributions to their big families,
Yep.
right? And now those big families that are used to getting cash and not doing anything, they got a capital call. And so it reminds me very much of, have you read Peter Turchin's End Times yet?
Mm, I
If
haven't, but
not,
I'm familiar with it.
oh
Yeah.
yeah, it talks about the elite overproduction. And what
Yeah.
happens is when you do follow families that for generations have built their wealth, they often don't make it through the fourth turning, right? So through that, because you're distributing to more and more and more people, right? And
Right.
so
And sorry to interrupt, but and they become dependents. So they're not necessarily
yes,
out there creating
that's
additional
right.
productive value. They're
That's
just
right.
eagerly waiting the next check. Yeah.
Exactly. And so yeah, so these folks are getting out, and I think the institutionals are starting to get out. I mean, everybody thinks, "Oh, Blackstone's going to come in and buy everything." Well, no, because they don't get a homestead exemption. I mean, this just doesn't make financial sense. This is why I often say math matters. And so that's not what's going to happen. And that they're not going to be able to save the market.
Sorry, for folks that don't know what the homestead exemption is, can you just briefly describe it?
Oh, sorry. So, in many, 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 many states, if you live in the home, you get a certain type of exemption because you're a homeowner occupying that. if you bought that, especially the institutionals who bought all these for long-term rental or even short-term rental, they don't get that same exemption. And those investors, small mom and pop, who bought their homes legally and won't get it either. There are many out there that are committing what we call non-owner occupancy fraud, and I'm seeing it all over my client books, Adam. I mean, it's everywhere. Saying that they were going to occupy the home, but my clients now realizing that they never intended to, and so there could be people claiming that homestead exemption that don't real, but the majority of the institutionals don't get that.
Got it. Hey, I'm just curious. So let's say you buy your home, you own it for 10 years, and you decide, you know what, we're going to go move to a different state, but you want to keep your old home and rent it out because you just don't want to leave it empty. What happens there?
Yeah, I would, if you don't tell anybody, I'm sure you
You're
just keep
violating
that
some.
exemption. Yeah, I mean, because, you know, uh, I think if you don't tell anybody, but you probably have to change your address. But we see how these things are not really enforced. But I think, by the letter of the law, I think you're supposed to actually, you
Okay.
know, uh,
But your point
yeah,
is no BlackRock can even claim it in the first place because they obviously know
that's right.
BlackRock's not going to be living there. Yeah.
That's right.
All right. Well, let's get to the devil's advocate question, which is, let's say in a year or two, everything's fine. What would need to happen to get us from here to there?
We need to find entire industries of jobs that will pay a good living wage, as well as perhaps, and I'm saying this facetiously, Adam, just
Yep.
for people that are listening, but perhaps a debt jubilee would do it. I mean, it's not only that we need jobs that can make a wage, for people to afford these homes, but they're so over leveraged that even if they got that job, they'd be spending the next 5 to 10 years paying down that debt. And so, including student loans. And that's a huge albatross around the necks of our youth. And so, no one wants to hear this, but if they change the bankruptcy code so that student loans could be discharged again, I think that would be helpful, but then those folks won't be buying anything for 5 to 7 years, So it would take a lot to really get us from there to here. As I often joke, if the UFOs land and give us all great paying jobs or tell us we don't have to work anymore, then
Okay.
sure.
If we all get our personal flux capacitors with the Mr. Fusion, yeah,
Yes,
attached to it.
that's right.
Okay. So um, we now have a new president-elect. Um, and from what I hear from you, correct me if this is erroneous, but what I hear from you is it sort of sounds you're like, look, what gives you so much confidence about where we're going is because it's just math.
Right.
If I can just reduce it to its basest amount, I feel like you feel like there's a material housing correction barreling our way, and it's unavoidable if the status quo doesn't change because of the math. So does that make you think that President Trump, this will be one of the challenges of his administration, is dealing with an ongoing housing market correction? And it sounds like maybe you think some of his policies might even accelerate the timing, at least, of it, if not the scope of the decline, because presumably he'll stop doing things like student loan forgiveness, probably do a few other things that might make it not as easy to cushion the blow or keep the market as propped up as it's been. Um, am I accurate in that assumption?
Yeah, so I think he will maybe, but he's going to get there pretty soon, I think, in terms of needing to do things like student loan forgiveness, believe it or not. But I do believe he's going to have that on his hands. I think I've seen no policy, right, initiative that would address this. In fact, I think we've got a couple of challenges right now. One with the overturning of Chevron deference. This is a whole new ball game when it comes to some of these programs, historically programs like HAMP and things like that. And so, which was the Home Affordable Modification Program during the
Yeah.
GFC. So I think gonna have a real mess on his hands without a lot of good options. And so we may actually, I'm sure I'll get a lot of hate for this, but we may actually see him talking about student loan forgiveness by the end of next year.
All right. It's sort of one of those like, I mean, you and I are still, I think, so bitter from the great financial crisis where Wall Street got bailed out and really didn't have to
Right.
pay the price. But it might be one of these presidential decisions of like, look, don't like the option, but I just feel like I got to do it to keep the system from totally imploding.
Right.
So, clearly, President Trump's goal is to grow the economy as much as possible. And so, he would be saying, hey, look, Melody, that's what I'm going to try to do is grow us out of this hole, right?
Right.
But some of others policies, like let's look at the deportation of undocumented workers, right? If that were to happen at scale, um, you and I have talked about this, sort of unclear. I don't think either of us thinks that illegal immigrants place that much upward pricing pressure in the housing market. But if that's incorrect, let me know. But probably more importantly, one of the industries that is heavily populated with or has a high percentage of undocumented workers is construction. And
That's right.
so what impact would it have on construction and new home sales and stuff like that if we were to start, materially deporting these guys or getting them scared enough that they self-deport?
Yeah, so that's why Laura Escobar of Lennar Mortgage has been all over the place recently, talking about the vicious cycle of housing. And she's basically asking for a handout. That Lennar got one last time because all the builders are fleeing to affordable home initiatives. That's where the
Mhm.
government money is. Because they all know if that does happen, like you say, and Adam, it's so wild that I spent all that time over 10,000 miles on the road, right? And I saw it with my own eyes, but didn't even feel comfortable talking about it. All of this, the housing market has been propped up on the backs of these illegal immigrants. No matter how you feel about it, this is how the builders were able to do what they
Right. It's
did.
been heavily subsidized because they're using
Yes.
off the books labor. Yeah.
Yeah, and so
Cheap off the books labor.
it will be terrible, right? I was just seeing something the other day about a community that said, you have to prove the documentation of your workers or you can't do it." And literally within 2 weeks they reneged on that policy. So it's going to be hugely expensive for the builders if he does that.
Yeah. I've been asking this question in my interviews of late, which is, if we assume that President-elect Trump is successful with his major policies that he's announced, can he be so without a lot of short-term pain to the economy? And the general consensus is no. Like and if that's true, just a note for President Trump in case he's listening, is you know, I highly recommend that he shift his communication to quickly to say, "Hey, America, I've inherited this massive hairball of an economy, and we're going to get to a great place, but we all got to sort of, have some shared sacrifice between now and there." Because I think right now the narrative has been, I'm going to deliver a beautiful economy for you, and everyone just thinks it's going to get better straight from here, right? Anyways, look, I can't control what the new administration thinks, um, but uh, let me just ask you to wax on this for a second because
Sure.
I'm just curious. So we have an underemployment problem in America, right? And increasingly, we have this large and growing cohort, 10 plus million at least, of uh, domestic able-bodied working age adults, age 25 to 55, whatever, who are just taking themselves out of the workforce for whatever reason. In many cases, they're demoralized. Um, and a lot of them are addicted. You become addicted to painkillers, right? Nick Eberstadt has written a lot about this. I did a really interesting interview with him that folks can go see on the channel. But we are under utilizing our human capital for the citizens that we have here, forgetting about undocumenteds that we're letting in. And I think a fair question is, hey, can we sort of do a swap, right? If we're removing undocumented workers that got here illegally, can we get people out of the basement basically back into a productive lifestyle and contributing back to the economy? I'm just curious to hear any reaction you might have on that. And I imagine that would be inflationary, right? These people are going to demand and need, wages that are higher than what these builders have been paying undocumented workers. But maybe the net benefit for society might be greater in the long run. Curious if you have any thoughts on this.
I have a lot of thoughts, but I love Nick's work. I'm very passionate about his work, actually. Seeing it all around me, seeing it in our young men specifically. And so to me, Adam, I think there would be a net benefit. It would take a lot of problem solving and solutions, but I absolutely believe we can get them back into the workforce. I mean, in fact, they may not have to leave their basement if we give them certain types of work, right? There's all kinds of things, but I know you're
Meaning
specific.
work from home work?
Yeah, yes.
Yeah.
There's all kinds of things you can do from home as well on your computer, that we've offshored to India. Okay. Like I come from the mortgage industry. I'd say 75 to 80% of all back end stuff is done. And this is why I've long argued India is not the great hope everybody thinks it is, because most of them are working for the US. And so I think if we pulled that back in, it would probably be a little inflationary, but come on now. There would be a net benefit to our society because I think so much, we've lost our connection to work, and we as humans are meant to work. I mean, we get our creativity through work, our understanding of who we are, and by losing that, I think that's how we've become unmoored as a society. And so I personally think this is the only problem to solve, Adam, and that's getting our folks back to work, and give them a living wage, but it's got to be productive work, but that means we're going to have to break down these narratives that these folks are lazy and stupid and all of this, and that's not the reality. They've been ignored by society in many ways.
Right. They're demoralized and they've lost hope,
Yes.
right? And this is a way to give them back hope and meaning and purpose. All right. Well, fascinating. You made a point that I won't go into deeply here, but it'd be worth talking more about in this channel going forward, including with you, is in a lot of ways, what we're talking about here is really a shift of giving American workers a little bit of a greater share of American profits. Because as you said, a lot of the work that's being done offshore is being done by American companies, right? So what that's doing is increasing the corporate profit margin,
That's
right?
right.
And it's punishing the American worker
That's
because
right.
the jobs are going elsewhere because the employer can get it for cheaper. So yes, it might raise the cost of doing the work a little bit, but those wages stay in America. They don't go somewhere else. So there's definitely a net boon to America. And yes, maybe we all might have to pay a little bit more, and maybe corporations might have to accept a little bit less on the profit side. But the net benefit to our society, to me, by my napkin math, seems like it would be a net positive.
Huge. And CEOs might have to make just a little bit less. Henry Ford always talked about the people who worked in his factories should be able to afford those cars, So, and I think people would agree that those are better times. And so, I think that absolutely it would be a net benefit. And honestly, it would also be efficient. I cannot tell you, I spent 2 years when I was at a fintech, managing offshore teams. And honestly, what we all kind of came down to is it is much easier and more efficient when we employ American workers because of the language barriers, the distance, all of it. And so I think that we've had so much narrative that the math is hard to see, but in reality, that's exactly what we need to be doing.
Okay. Um, well, Melody, it's always such a joy talking to you. So many additional topics I'd love to get in with you, but I think we'll punt a fair amount of them until the next time. I do want to note on, potential work from home work for these folks. It sounds like the non-bank lenders are going to need a lot of people to be points of contact. So maybe we start there, huh?
Absolutely. And that typically, I'm sure they'll try to figure out how to get around this, Adam, but those are supposed to be US based employees. So, that's kind of the rule, but I have a feeling they're already jockeying to offshore a lot of that activity. But yes, going to need a lot of single points of contacts to help with the default wave that's coming.
Okay. All right. Well, look, as we start to wrap up here, Melody, maybe if you could just crystallize your outlook for the housing market, say for the coming year. I've certainly taken away from this conversation. You think prices are going to start coming down on average. In fact, let me ask this. Last time we talked, I think it was the first time I heard you make the prediction that you said you think nationally housing prices are going to close the year negative. Maybe not by a lot, but it will be a down year for the US housing market. A, is that still true? And then do you expect that that fall in prices to continue and maybe be larger in 2025?
Yeah, I think when it'll depend on which series we look at.
Okay, so it'll be
But
close.
I do think that's still true. I want October data to finalize that forecast, but I think it will absolutely be true in median listing price. I think it'll be absolutely true for new homes. I think it may even be true for National Association of Realtors, that series. Case Shiller is kind of the big unknown because they don't capture condo sales. They don't capture repeat sales like within 6 months.
Okay.
But we may actually see that as well because I'm seeing crazy stuff, Adam, like a home that sold 2.5 million and then, now it's sold for 1.2. And so
Hmm.
if that doesn't start showing up in Case Shiller, that thing is completely broken. But I'll have a more definitive answer after October data, but I still do believe we could end the year negative home prices. In terms of and then I think delinquency is going to be ticking up from here. They will try to do everything possible, but just as the loan modifications didn't save us last time, they won't save us this time as well. And with that, delinquency will be an increase in distressed sellers because everybody thinks they can sell. So that's what they're going to try to do first. And so by June of next year, I believe we're going to see material delinquency. And so 2025 is where I think we'll see the biggest drop in home prices, followed by probably subsequent years of minimal but still persistent drops in home prices.
Okay. Is it, I'll have you back on repeatedly beforehand so you can call audibles along the way. But right now, are you sort of saying you think it's the spring selling season, the June 2025 is when the wheels really start to come off this, where it's not going to be a debate about what's happening with housing. People are going to look at the data and say, yeah, this is not good.
Absolutely. And unless the UFOs come.
Okay. All right.
Just kidding.
Well, look, as we start to wrap up here, I do this to you often when you come on the channel. Can you just give your parting counsel to aspiring home sellers and aspiring home buyers?
Sure. If you think you're going to be selling in the next 12 to 24 months, honestly, list it. Just list it to see what you can get out there. Those estimates are not accurate. Fannie Mae did a study where they looked at over 7 million comparables on appraisals and saw that over 55% of them didn't properly list seller concessions, meaning that let's say you sold the home, but you sold it without a new air conditioner and you got $1,000 off, something like that. Well, people haven't had money to make those repairs. And so the fact is, when they went to refi, when they go to sell, they're going to suddenly wake up to an understanding that having not made those repairs, that home is definitely not worth what their estimate says. And that is a lot. There's a lot of fraud people are not taking into consideration. So please, 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 sellers, do not be surprised. I just please check is what I would say. I think you're going to be surprised. So if you can list to buyers, hold on, vote with your dollars. You cannot afford these prices. You simply cannot. Not even the richest person, Adam, would this make sense to. I mean, I'm seeing luxury right now flying onto the market. Stories about famous people letting go of properties. They're cherish Billy Joel, some property in the Hamptons, some, somebody else, because the carrying costs just don't make any sense. And by the way, that goes back to what you're saying about immigration. All the help that runs these huge luxury are going to be going potentially be going away as well. So this is all, it is too expensive out there for any buyer right now. So just vote with your dollars and hold on. And let's see where we are by June of 2025.
All right. Well, very wise counsel. Well, folks, look, if you want to stay on top of this story, a great way to do that is to follow Melody. So Melody, for folks that would like to follow you and your work, where should they go?
So I'm on X Twitter as M3_Melody, M3 Melody Substack, and M3 Melody YouTube. And so the Substack is where I really jam pack it with data that supports what may sound like crazy talk to everyone, but I support it with numbers and facts as well as boots on the ground. I go and look at these markets. I don't just talk about it, from my chair.
All right. Well, look, as a subscriber to all those, I can't compliment the quality of the work you do, Melody, highly enough, and highly encourage everybody to go there. Melody, hang out just for 1 second. I got 30 seconds of housekeeping, and I want to give you the last word. Folks, if you've enjoyed this conversation with Melody and would like to have her come back on as soon as she's got something new in her outlook to report to us, please encourage her to do that by hitting the like button and clicking on the red subscribe button below, as well as that little bell icon right next to it. Housing for many people is one of, if not the biggest asset in their personal net worth. So if you're wrestling with decisions to make about real estate, highly recommend you do that under the guidance of your professional financial advisor who can, help you make those decisions given the totality of your personal wealth situation. If you've got a good advisor who can do that for you, great, stick with them. But if not, if you'd like the feedback, maybe a second opinion from one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. You can schedule one of those by just filling out the short form at thoughtfulmoney.com. Again, these consultations totally free. There's no commitment to work with these firms. It's just a free public service they offer to help as many people as possible. And last, if you're there at thoughtfulmoney.com, be sure to click the newsletter link at the top of the site to sign up for our free Substack. All right, Melody, like I said, it's just always a pleasure. Thank you for coming on and giving so much of your expertise and wisdom to our viewers, as well as for all the great work you're doing out there in the world, help support the victims of the recent hurricanes. Is there any parting bit of counsel that you'd like to offer the audience here as they, go forth from here trying to figure out, what they want to decide to do with the real estate that they might have or are aspiring to have?
There is hope. There's hope out there. And I just want to say, what I've seen recently in this area with people, Americans coming together and breaking down narratives. This narrative too shall pass on the inventory shortage. Just hold on to that hope, but be doing your research in the meantime. Get ready, know where you want to live, and not because somebody told you that you want to live there. Go check it out. And be ready because, it's coming no matter what those in the media want to say about it.
It'd be interesting. I think it would be really interesting to do so you're hoping to buy a house in this coming real estate market that we think is arriving. It would be great to do a webinar where we just tackled that specifically, and you can give kind of your, because I know you have a number of different best practices and strategies that folks can follow. And then we can let folks actually ask, questions live of you as well. Is that something you'd be open to doing? I know I'm going to put you on the
100%.
spot
I would
here.
love it. No. I would love that. I love that. I mean, I'm all about as much as I can educate, Adam. That's why I do this. That's the only reason, and to maybe help save people from pain. So I would love to do that.
All right. Well, folks watching, if you'd like to see that happen, let us know in the comment section below. And if there's enough interest, we'll do it. Melody, can't thank you enough. Always such a joy.
Thank you so much, Adam.
All right, everybody else, thanks so much for watching.